Welcome to the deep dive, everyone. Today we're cracking open a really fascinating stack of notes.
Yeah, it's a great collection this time.
It really is. It was compiled by an investor
Mm-hmm.
who was basically searching for this very specific holy grail.
Right. A very common pursuit, honestly.
Exactly. So our mission for this deep dive is to explore their research into various investment vehicles. We're specifically hunting for a viable solution for the active investor who feels completely restricted by traditional stock market rules.
And more importantly, restricted by market hours.
Yes, the hours. It's a pain point that almost anyone with a day job and an interest in finances slammed into at some point.
No, absolutely. I mean, it's a universal struggle.
Okay, let's unpack this.
Mm-hmm.
But before we get into the weeds, I need to establish the ground rules straight from our source material.
Always a good idea.
Right. So this deep dive is not financial advice.
Mm-hmm.
It is strictly an exploration of one investor's research and their personal experience.
We are definitely not talking about your tax-advantaged retirement accounts today.
No 401ks or IRAs here. This is for individuals who want to actively manage a portion of their portfolio. And, as always, you must invest at your own risk.
That is a very necessary boundary to set, because what we are really examining today is the architectural design of different financial vehicles.
The mechanics of them.
Right, the underlying mechanics. We want to understand how they either trap the working professional in this unwinnable scheduling conflict, or, how they might actually set them free.
Okay, so to appreciate the ultimate solution our source landed on, we really have to look at why the standard options just fail the stress test of a normal working life.
They really do fail it.
You know that feeling of trying to manage your investments while you're supposed to be focusing on your 9-to-5 job?
It is incredibly stressful.
It's the worst. You're sitting there in some Tuesday morning status meeting, right? Nodding along to a presentation about, quarterly deliverables.
Right, trying to look engaged.
Yeah, but under the conference table, your thumb is just frantically swiping on your phone.
Oh, I've been there.
You're watching a stock chart plummet, and you're trying to calculate if you can execute a trade before your boss asks for your input on slide 7.
It forces you into this bizarre double life. I mean, you are attempting to do two highly demanding jobs simultaneously.
Which, almost guarantees you'll perform poorly at both.
Exactly. You miss the critical nuance in your career, and then you end up making these rushed emotional decisions with your capital just because you're watching the clock.
So if that's the problem, what's the first logical escape route?
Yeah.
Usually people look to tangible physical alternatives.
Like real estate or art.
Yeah, real estate, art, maybe high-end watches. The logic is always, I'll just buy a rental property or a vintage Rolex, and I won't have to watch a stock ticker all day.
The appeal of the tangible asset is definitely understandable, but our notes highlight why this is kind of a mirage for the active investor.
Because of the friction, right?
Right. The fatal flaw here is the friction of liquidity. Mechanically speaking, you can't just click a button and turn a commercial property or, a painting back into liquid capital to seize a new opportunity.
Right. Like if you spot a massive macroeconomic shift on a Tuesday, you can't exactly liquidate a duplex by Wednesday to capitalize on it.
Not at all.
You have to find a buyer, negotiate, get appraisals, clear escrow.
Which takes months.
Yeah.
Furthermore, to actually generate active returns in those physical markets, you need profound specialized knowledge.
Like zoning laws?
Zoning laws, art provenance, or horology for watches. And for someone who already has a demanding 9-to-5, acquiring that level of granular expertise is often just a bridge too far.
So true. So if the friction of physical assets pushes us back into the paper markets, we enter the realm where most retail investors live.
The traditional markets.
Right. Stocks, bonds, mutual funds.
Mm-hmm.
Let's touch on stocks quickly. I mean, most of our listeners know the basics. You're buying fractional ownership and voting rights.
Sure.
But the notes point out a stark mechanical reality about stocks for the active trader. It's basically a binary 50-50 directional bet.
Yeah, when you buy a share of a company, your primary mechanism for profit is that the share price goes up. If it goes down, you lose money.
Simple as that.
I mean, yes, there are dividends, portions of profit a company might elect to distribute, but your core risk is entirely tied to the upward trajectory of that specific corporation's valuation.
And if you don't want that equity risk, the traditional pivot is usually to bonds or treasury bills,
where the mechanism fundamentally shifts from ownership to debt. You are lending cash to a corporation or the government.
And the advantage there is predictability, right?
Exactly. The profit opportunity, the yield, is a known percentage established at the time of purchase.
But the trade-off is agility. Those interest payouts happen on a very rigid schedule.
Too slow for an active investor.
Yeah. So if individual stocks are too risky and bonds are too slow, an investor naturally looks to pool the risk.
Which brings us to mutual funds and ETFs.
Right? Exchange-traded funds. And this is where the mechanics of time really start to reveal the trap. Let's look at mutual funds first.
So mutual funds are these massive baskets of assorted stocks or bonds, and they're heavily utilized in those retirement accounts we mentioned earlier.
Right.
But the structural quirk of a mutual fund is how its price is actually calculated. It relies on something called the net asset value, or NAV.
And the notes are very clear about when that happens.
Yeah.
It is strictly at the end of the trading day.
Only at the end of the day.
Why is that, though? Like, why can't I just buy a mutual fund at noon for a noon price?
Because it is literally impossible to calculate the value of that basket while the market is open.
Oh, because the prices are moving.
Right. A mutual fund might hold 500 different stocks. Throughout the day, the prices of those 500 stocks are fluctuating wildly.
That makes sense.
So the fund managers literally have to wait for the closing bell to ring, let the dust settle, tally up the final closing prices of every single stock in the basket, subtract the fund's liabilities, and then divide that by the number of outstanding shares.
Wow.
Only then do they have the net asset value.
I see. So it's kind of like buying a ticket for a commuter train that only leaves the station at midnight.
That's a good analogy.
Like, you could see a massive news event break at 10 a.m. You could put in your order to buy or sell your mutual fund right then and there, but your order just sits on a platform.
It doesn't actually execute.
Right, not until midnight or, the end of the market day. And you are completely locked into whatever the price happens to be at that time. You have zero control over the intraday timing.
That is a perfect way to visualize it. Now, ETFs, exchange-traded funds, they were created specifically to solve that mechanical lag.
Okay, so they fix the time delay.
Yeah, they allow you to trade that basket of stocks continuously throughout the day, just like a regular stock. And then, at the furthest, safest end of the spectrum, you have money market funds and high-yield savings accounts, which just pay out monthly interest, totally detached from daily market swings.
But here is the grand realization, right?
Yeah.
The shared flaw, tying all these traditional assets together, stocks, ETFs, bonds.
The hours.
Yes, they're all chained to the traditional market hours. In the United States, that means 9:30 a.m. to 4:00 p.m. Eastern Time.
Which are the exact hours you are expected to be physically and mentally present at your day job?
It creates an unresolvable conflict. I mean, the traditional markets operate on a schedule designed over a century ago. It predates the internet, algorithmic trading, globalization.
All of it. Yet modern working professionals are still forced into this time cage.
Right. If a market-moving event occurs at 1 p.m. and you are leading a team meeting, you are paralyzed.
Totally helpless.
Okay, but I have to push back here, though. What about equity options?
Yes.
Because I hear about active retail traders using options all the time.
Mm-hmm.
Don't those solve the binary 50-50 problem of stocks and give you more control?
They do offer incredible strategic control, yes. But they completely fail to solve the time problem.
Really? How so?
Well, let's unpack the mechanics of equity options. When you buy an equity option, you are not buying the stock itself. You are buying a derivative contract.
Right.
It gives you the right, but not the obligation, to buy or sell that stock at a specific price before a specific expiration date.
So because I don't own the underlying stock, I don't get any dividends.
Correct. But what you gain is directional flexibility and leverage. You can buy a call option if you think the market is going up, or a put option if you think it's going down.
Right, I've heard of calls and puts.
Yeah, and you can construct trades that profit from high volatility, or even trades that profit if the stock just stays completely flat. It is a highly sophisticated tool for an active investor.
I mean, that sounds like exactly what our source was looking for.
Mechanically, yes, but practically it's a trap, because equity options are tethered directly to the underlying stocks. Therefore, they trade strictly during those exact same 9:30 a.m. to 4:00 p.m. market hours.
Of course.
In fact, options can be even more stressful during those hours because they are leveraged and incredibly time-sensitive.
Right, the expiration dates.
Yeah, the time decay on an options contract means you have to watch it even closer than a stock.
So the video game analogy applies even more. We are right back to swiping under the conference room table, just sweating through a Tuesday status meeting.
Exactly.
We need an asset class that simply doesn't sleep when the New York Stock Exchange sleeps. And that brings us to the major pivot in our source notes.
Futures.
Yes, specifically financial futures.
This is where we step into the institutional side of finance. A futures contract is fundamentally different from a stock. You aren't buying equity.
Okay, what am I buying?
You are entering into an agreement to buy or sell an asset at a predetermined price at a specified time in the future.
But the notes specify financial futures. I mean, I always thought futures were just for commodities, like farmers hedging the price of corn or airlines hedging the cost of jet fuel.
Well, that is the origin of the futures market, yes. But financial futures take that exact same mechanical contract and apply it to financial instruments.
Got it.
The most popular ones are aligned to the performance of major market indexes. So think of the S&P 500, the NASDAQ, or the Russell 2000.
Oh, so instead of trying to pick the winner between two tech companies, you're taking a position on the macro momentum of the entire tech sector via the NASDAQ index.
Exactly.
It completely abstracts the investment away from individual corporate drama, like a CEO scandal or, a bad earnings report, and focuses on broader economic momentum.
That macro focus is a huge benefit. But the truly revolutionary aspect of financial futures for our working professional isn't just what they track. It is when they trade.
Yes. This is the massive reveal in the notes, the schedule.
That changes everything.
The traditional stock market gives you 6.5 hours a day. Futures trade from 6 p.m. Sunday evening straight through to 5 p.m. on Friday.
The only interruption is a brief 1-hour maintenance window each day.
It's a 23/5 schedule, 23 hours a day, 5 days a week.
Yep.
And I know what you're thinking because I thought the exact same thing. Wait, 23/5? Does that mean you were supposed to be glued to a glowing monitor at 3 a.m. on a Tuesday?
Which sounds awful.
Because honestly, that sounds like a faster path to a heart attack than the 9 to 5.
It really does, but it's the most common misconception about continuous markets. The value of a 23/5 schedule isn't about giving up sleep.
Okay.
It's about taking back your agency. It provides the ultimate relief from that rigid workday schedule.
Walk me through how this actually plays out for someone with a career, like day-to-day.
Sure, under the traditional system, your investment window overlaps entirely with your career window. But with a 23/5 schedule, the friction disappears.
Because you have other options.
Right. You can commute to your job, focus 100% of your energy on your career, come home, have dinner with your family, and then at 8:30 p.m., when the house is quiet, you can sit down, analyze the global markets, and manage your portfolio.
Or if you're an early bird, you can wake up at 5:30 a.m., drink your coffee, read the overnight news from Asian and European markets, and execute your trades before you even put on your work clothes.
Exactly. You are no longer forcing your wealth-building strategy to compete with your career for your time.
That is so freeing.
It also protects you from one of the most stressful events in traditional trading, which is the opening gap.
Oh, I hate the gap.
Right. If terrible economic news drops at 8 p.m. on a Tuesday, a traditional stock trader can't do anything. They have to wait in terror for the 9:30 a.m. bell the next morning, just watching the stock open way below where it closed.
But because the futures market is open, a futures trader can react to that 8 p.m. news at 8:01 p.m.
Precisely. The 23/5 schedule bends to fit the reality of your life, rather than forcing your life to bend to the market schedule.
Here's where it gets really interesting, though.
Oh yeah, the synthesis.
Right. Our source author doesn't just advocate for trading straight futures contracts. They combine the best mechanics of everything we've talked about to find the absolute sweet spot.
It's brilliant.
The core recommendation for the active investor is an instrument called options on futures.
It really is a brilliant synthesis. We established that equity options give you unmatched strategic flexibility, right? Allowing you to profit on directional moves up, down, or sideways.
And using leverage to define your risk.
Yes, but they were trapped in daytime hours.
And we just established that futures give you that incredible 23/5 schedule relief, tracking broader, more stable market indexes.
So, options on futures simply marries the two mechanics.
I love that.
You are buying or selling an option contract, but the underlying asset isn't a share of Apple or Microsoft. The underlying asset is a futures contract on something like the S&P 500.
Oh, okay.
It functions very similarly to the equity options market in terms of how you analyze volatility and construct your trades, but it completely unlocks those global 23/5 market hours.
That is the holy grail for the active investor. You get the strategic depth and limited risk capabilities of options combined with the schedule relief of futures.
Exactly.
The notes explicitly argue that this is the vehicle that allows an investor to effectively manage a sophisticated trading activity without it clashing with their day job.
It resolves the initial tension perfectly, but we have to pause here.
Oh,
The catch. Well, not a catch, but a reality check. If you are going to be operating in a leveraged 23/5 environment using options on futures, you absolutely must understand the plumbing.
the behind-the-scenes stuff.
Right. You have to understand how risk and money are actually managed behind the scenes when the market never sleeps.
Because if this massive global casino is open 23 hours a day, someone has to be keeping score,
Right.
making sure traders can actually cover the bets they are making in the middle of the night.
Exactly.
The notes bring up a highly specific term for how this works with both futures and options on futures. They call it span margin. How does span margin actually work?
To understand span, we first have to contrast it with traditional margin.
Okay, let's do that.
So margin is simply the collateral, the buying power that your broker requires you to lock up in your account to cover the risk of any trade you place. In traditional equity options, margin is overwhelmingly fixed and rules-based.
Meaning if I execute a specific trade, the broker holds a predetermined flat amount of my cash, regardless of what the broader market is doing.
Yes, it's a rigid requirement. But span margin, which stands for Standard Portfolio Analysis of Risk, operates on a completely different paradigm.
Okay.
Our source defines it as a risk-driven calculation by the broker that reduces your available buying power. But the secret sauce is how it calculates that risk.
The notes mention that span margin is determined dynamically during the day, right up until the evening clearing process.
That dynamic calculation is key. Span doesn't look at individual trades in isolation. It uses complex algorithms to look at your entire portfolio as a whole.
Oh, wow.
Yeah, and it constantly runs simulated stress tests. It asks, what is the maximum probable loss this specific portfolio could suffer over a single trading day, given current market volatility?
Okay, wait, so is span margin basically like a smart thermostat for your money?
A smart thermostat.
Yeah. Think about a cheap, old-school space heater. It just blasts a fixed amount of heat all day long, wasting massive amounts of energy regardless of the weather outside.
Okay, I follow.
That's like fixed equity margin. It's rigid. But a smart thermostat dynamically adjusts the required energy based on the actual temperature, or in this case, the volatility and risk at any given millisecond.
That is an excellent way to conceptualize it.
It only locks up the exact amount of capital necessary to cover the current environment.
Precisely. Span margin is dynamically evaluating the temperature of your risk. If you have two trades in your portfolio that naturally offset each other, say one trade profits if the market goes up and another profits if it goes down, the span algorithm recognizes that your overall risk is actually lower.
Oh, that's smart.
Therefore, it requires less margin collateral.
Which means it is a far more efficient use of your capital. You have more cash available to deploy because the broker isn't just blindly locking up funds based on some archaic rulebook.
Exactly. And the notes point out a crucial systemic backstop to this dynamic process. While your individual broker might have their own specific buffers during the day, the ultimate arbiter of this risk is the CME.
The Chicago Mercantile Exchange.
Yes, or a centralized clearing firm.
So they're the neutral umpire in all this.
Yes. Every evening, the clearing firm steps in, reconciles all the accounts, and finalizes the span margin requirements based on standardized data. And the critical detail here is that the CME will never exceed that mathematically calculated risk.
That's a huge safety net.
It is. The actual debits from your account are strictly based on this nightly standardized risk position.
So you have a highly capital efficient, dynamically risk-managed system supporting a market that operates on your schedule, not your boss's schedule.
It is institutional-grade architecture made available to the retail investor.
Wow. So what does this all mean? Let's take a step back and view the entire landscape our source has navigated today.
It's been quite a journey.
It really has. We started with the frustration of the 9-to-5 worker trying to build wealth. We saw how physical assets like real estate trap you with a lack of liquidity.
Then we examined the traditional paper markets, stocks, mutual funds, and ETFs. We broke down the mechanics of why they fail the working professional.
Yeah, they lock you into a rigid daytime schedule that directly competes with your career.
Even traditional equity options, despite their strategic brilliance, leave you trapped in that same time cage.
But then we looked at the mechanics of financial futures. We found an asset class detached from individual corporate risk, trading on a global 23/5 schedule.
And by synthesizing those concepts into options on futures, we found a vehicle tailored for the active investor.
The Holy Grail.
Yes, it provides strategic depth, it operates when you are actually available to trade, and it is supported by the dynamic, capital-efficient architecture of span margining.
It is a complete paradigm shift in how you can approach active investing.
Yeah.
It proves that you don't have to choose between being dedicated to your career and being dedicated to your portfolio.
You really can have both.
But, exploring the mechanics of a 23/5 market leaves me with a pretty massive lingering question.
Oh, what's that?
Well, if complex financial instruments like futures can successfully operate on a continuous schedule, dynamically stress-testing risk around the clock to accommodate a global interconnected world,
Right.
are traditional 9 to 5 stock market hours destined to become an outdated relic?
Oh, that is a fascinating question. The plumbing to support a 24-hour equity market certainly exists now.
Right. If the futures market has already proven that finance doesn't need to sleep, how long until the rest of the financial world is forced to follow suit?
It feels inevitable.
If the opening and closing bells eventually disappear entirely, it fundamentally changes what it means to be an investor.
It would completely rewrite the rhythm of global commerce.
Definitely something to mull over the next time you're sitting in a Tuesday morning status meeting pretending to look at a spreadsheet.
For sure.
Hopefully this deep dive has given you a glimpse into how you can escape the stress of stealth trading under the conference table and, find a system that actually respects your time. Thanks for joining us, and keep questioning the traditional rules.